He's angry about mortgages. It's Angry Mortgage. He's swearing. He's cursing loud. He's old. He's opinionated. And he's been doing this so damn long. This program is about mortgages, and this is mortgage advice, but the advice may not apply to your situation. Contact licensed mortgage professionals for specific recommendations before you make decisions about mortgages. You may not agree with Ron, but if you don't, he thinks you're wrong. Oh, and did we say there is a lot of swearing?
And we are back. Look, it's like a very, very exciting program. And I'm not usually excited about shit because I'm old, okay? This has been a subject of mine, and finally I'm with a guest who we share the same subject that we have been fascinated with for the last, 18 months, 16 months, really, really fascinated by this whole thing. Mark Morris is a lawyer at Legal Closings. He's the founder of Legal Closings. Very well-known lawyer in Ontario and Toronto. On top of all real estate issues, you've been deep into it for what, forever?
More than 20 years
More
at
than
this
20
point.
years.
Yeah.
Okay, all right. And Mark's subject of interest is the same as my subject of interest, which is the 416 Condo Crash, okay? And the reason that I feel so good about this is I don't always get to talk to people who understand the deep issue that we're in right now, the deep shit that we are in the condo business in Southern Ontario. Because a lot of people, first of all, if you never went near a condo, you don't know, right? If you never owned one, never looked at one, never bought one, never had one, don't live in one, you're not in it. And the other thing is, I think this is a fair statement, and I'll ask you because I think I'm right. The developers themselves want to keep this stuff under wraps. Is that relatively true?
I think that's without question.
Question.
They have a financial interest in doing so.
Financial interest in keeping the story of the condo crash sub dura, something that's on the quiet.
Which is why it probably doesn't help when the Toronto Star chooses to write a front page story about it yesterday.
That was a shittery for sure. And yet Mark and I, not just amongst ourselves and a group of people that we know, have been talking about this condo issue for well over a year. It's 14 months, give or take. We've been constantly focused on it, thinking about it, because the truth is it seemed incredibly fucking obvious, okay, that something was going to happen. And it's taken some time, or maybe not. Maybe 14 months is just about right. What do you think?
Well, let's just follow your statement, first of all. It's taken some time for the shit to hit the wall, right? I don't know that I'm an expert as to exactly how long these things take to crash. I don't know that anyone is, because that's the essence of a bubble, right? It's always trying to time a bubble. And anyone who says that they can time a bubble usually loses that game. Mm-hmm. But what is very clear is that the bubble has deflated, if not popped. And we are now starting to deal with not only the implications of that in our industry, but also the way it's going to be contagious to other portions of the industry that may not even be condos. And we can talk about that today.
And we are going to talk about that. So, I decided I would really love to do, and Mark is also so knowledgeable on this thing. Mark actually knows things about this condo situation that are virtually unknown, but he knows them. Okay, so I'm going to try to go back to the very beginning, because sometimes when people, this is a common theme I get on my replies on the comment section. Okay, a common theme is when we talk about the condo crash in Toronto, is how the fuck did nobody know this was going to happen? Like, there's banks and builders and government and so many people involved. How can this have gotten to the point that it has without anybody stopping and saying 2 or 3 or 4 or 5 years ago, wait a second, this doesn't make sense? So we're going to go all the way back in time to sort of illuminate that point. Like, how did we get here? And what is the answer? By the way, it's a damn good comment that we get is, wait a second, developer didn't figure this out, buyer didn't figure this out, government didn't figure this out, bankers didn't figure this out? Because at the end of the day, you need a bank to finance that big condo building, right?
Yep.
So how could everybody miss this how is it possible? And we're going to explore that today by going back to the very beginning. So let's go back to the very, very beginning of condos in Ontario, because up until I would say about late 1980s, there were no condos. I think they needed to bring out an act to make it actually work. Okay, so that it was legally possible to have title on strata buildings. Okay, so there were condos in the 80s, and then we had the 1990 real estate crash in Ontario, which decimated the condo industry, and it quieted right down. Everything calmed right the fuck down in 1990. It was a real estate bubble similar to what we're seeing now on nowhere near the same scale, not even close. And then it popped, and prices fell dramatically. Condos fell about 38%, single family, all across the board. It didn't matter where it is. It could have been in the best neighborhood in Toronto. It fell about 25%. Okay, houses fell 25%. And that's mostly what there was. The town was 90% houses back then. There was a few condos, but it wasn't big. So it started to get going again in 2006. So let's go back in time then, Mark. So 2006, people were buying condos. And is it fair to say they were people buying for themselves? Does that make sense? A lot of people say, well, I'm going to live here, or my kids are going to live here, or somebody's going to live here. Is that fair to say?
Absolutely. I mean, at the end of the day, that's the type of home ownership that they knew at the time, right? If you put yourself back into the early 2000s, not very few people, but relative to today, few people were actually purchasing for investment opportunities. They were purchasing for themselves, or their kids, or anything else.
Yeah,
exactly.
Fair, yeah.
And as a result, when condo product hit the market, people did what they knew how to do with real estate, which is continue to invest for themselves. Interestingly, by the way, 2006 was the beginning of the divorce between Canadian incomes and housing price
in Ontario,
right? It was the very point at which real estate became more unaffordable relative to the incomes that people were earning. And of course, condos provided a unique answer to that insofar as the purchase price of a condo was usually less than a single detached home.
So it became an outlet for people who wanted to own a property.
Correct.
But the detached home was because it had a huge run up in the 80s, took a fall, but it was still damn expensive compared with incomes. Okay? Correct. So the condo didn't look like the condos of today, did it?
No, absolutely not. Because if you think about it, if the approach that people were taking to condos was this can take the place of what it was I was expecting, a single detached home, well, then you need the space for a single detached home. You need 2 bedrooms, you need a larger bathroom, perhaps the powder room.
There was a dining area.
Correct.
Yeah.
And in fact, if you take a look at the older condos, all older condos usually have higher condo fees. One facet of that is, of course, construction deficiencies and the fact that older condos require more. But more importantly, the per square footage is the square footage of these individual units is significantly more than what we see today.
And they all had a storage locker, and they all had 1 or 2 parking spaces.
How could you not?
How could you not?
This was taking the place of your house.
Yeah, and the audience has to think about that for a second, because condos have morphed into something that is completely different. So if you're somebody who's in their 30s and 40s, you're thinking to yourself, what are you talking about? A 2-bedroom condo, 2 parking spaces. What are these guys talking about? But that was what it was.
And in the 90s, if I may just interrupt for a second, the vast majority of those condos that were coming in were exclusive use for parking and locker. I bring it up only because exclusive use means that they can't be separately sold, that they are part of the unit.
They're tied to the unit.
So integral to the unit's functionality are they that we don't even need to make separate pins, because you're not going to sell your parking spot. This is where you live. And
nobody ever heard of selling a parking spot.
Exactly. Separate pins came about afterwards as we started to reimagine
what condos are. Pins is like a title.
Sorry,
like there's a separate title. In other words, a parking spot, you could actually trade that title. You could sell or buy that title to that parking spot. So that's what a pin means in the real estate business. Okay.
Thank you for that.
Okay. So, and by the way, this is, we're going back in time because again, to answer that question of how the fuck did we get here, you have to know the history. So Mark explains it perfectly. Condominiums were meant to be a functional home for people that were used to either a fairly spacious apartment, because there was lots of apartments. There's always been apartments in Toronto for 100 years, but more particularly to say 1,000 square foot, a little smaller, but 1,000 square foot post-war bungalow that they built jillions of all across Toronto after the Second World War, and that's all they ever were, 900 to 1,000 square feet. So when you had an 850 square foot or an 800 square foot or 900 square foot condo, well, this is just like we had in the bungalow, right?
And it also, if I may just add, although this has nothing to do with the financial problems that we're in right now, I would also add that it also it was right for the times, insofar as particularly women who were single at the time and still looking to get into the property market were able to afford a property that ultimately provided them with security. And there was a huge amount of demand from young people specifically because of the security that a condo provided as well, just as a background to watching it take off.
And by the way, this is an excellent point Mark makes. So today, even if you look out throughout North America, single women, even to this day, like forget about the crazy town and crazy world in Vancouver and Toronto, but if you look at the United States, and medium-sized, and there's lots of medium-sized and even bigger cities in the United States, where women have become primarily the homeowners in those small cities, because, in other words, they're the majority of the single people living in, say, Charleston. Of the single persons who own homes in Charleston, the majority are women. Okay, so this is a great point that this was an opportunity because the price points for where they were for a woman in her mid-20s to say, well, I'm sort of established at work now. I have saved up enough. Because here's the really wild part about going back to 2005, 2006. They were about $200 a square foot, right?
That's right.
Yeah. So it's a 800 square foot unit was $160,000.
That's right.
Okay. Like, what says the world out there? What are you fucking talking about, Ron? A condo was a condo was 169, 179, 189 in 2005. Okay. That's reality. And that's affordable.
Yep.
And CMHC would do 5% on those condos. And so it was an affordable point for people to start into the housing market. The old story of a condo being a starter home actually was true at one point in time. Like, it was actually true. And we're going to watch the evolution of what happened afterwards. We're going to talk about it. So at that moment in time, we're going to leap forward from like 2005, 2006 to 2011, 2012, which is when things fundamentally changed. Do you want to talk about that for a second, Mark, how things fundamentally changed?
Yeah, sure. 2011, 2012 became what I kind of identify as the modern genesis, really, of the problem that we're currently experiencing. It's probably where condos kind of moved from, well, this is just another housing type and it's the entry level, and then we're going to sell this and get our house out in Vaughan or whatever it may be, to something slightly different. Canada, as much as I love this country, and I know you do as well.
Yeah, no 51st state for you and me. That's for sure.
No, absolutely not. But elbows up, man. Elbows up.
Fuck the elbows. No. But no 51st state. No 51st state. Yeah.
The idea of a condo as an investment largely arose during the 2011-2012 period. Mm-hmm. Canada's economy is not as vibrant as much as we would like it to be as it is perhaps south of us. People aren't starting businesses all over the place or anything else. Really, we make money in Canada traditionally, the vast majority of us, through investments in the market and presently through real estate. And that factor...
And certainly in 2012 and 100%. In real estate. Yeah.
And what we saw in 2011, 2012 is that condos became a vehicle for investment in a way that they were not prior to those times. And so what we saw was the demand for condos started to hem from not just end users, but people who already had a property and were now looking to derive rental and wealth value creation And that meant that fundamentally you had people who were owning 2, 3, 4 condos, and this was their investment strategy for wealth.
Okay, so let's talk about that for a second. So, when I first encountered, because I've been doing mortgages and Mark's been in real estate law forever, and I've been doing mortgages forever. So what we encountered at some point was the idea, because when I first started, all I ever did was mortgages for people who wanted to buy a house to live in.
Right.
That's all I did. Okay. And then as you're suggesting, we came into this period of the early 2000s. And this simple and not a bad idea arose that, hey, I got an idea. Let's buy a house as an investment. That eventually became a condo, but let's buy a house as an investment. The tenants pay the mortgage. A chunk of the mortgage is principal. So I get to write off the interest against my income tax. The tenant pays the whole mortgage payment and the property tax. And then over the course of years, because at that time, it was thinking about a long-term vision of investment, that in 25 years or less, the mortgage will be paid off. I'll have an asset that's fully paid for, and I'll be approaching retirement, and that rent will be sheer profit.
And the critical component, and I know that this sounds very common to your listeners because everyone's involved in the rental market and they understand it now. But if you actually sit back and think about what is going on with passive income investment, like the ownership of a condo, I have a good client, and he runs a restaurant, and that restaurant makes upwards of $4 million in revenue per year. He's been doing it for 25 years.
Damn fine restaurant. Actually a chain. Most of you would know it if I actually said what the name is. Has 5 locations, big, successful. He once walked into a bank with no real estate assets and said, here's my financials for the past 5 years. Can you give me a loan? And do you know what the bank said? You should own some property.
That's
we can
right.
do a HELOC on.
The bank said, you can screw right off. Thank you very much. Where's your assets? He didn't want to put up his personal assets. He had to in the end. The reason that these financial pro formas worked with the renters was not only the fact that there was something that people could identify, they could ultimately figure out how to generate income pretty easily. That's why it's called passive. It's also because they were borrowing at government rates. And borrowing at near government rates or government rates is something that Canadians do not get from their banks or from any other investment opportunity very readily.
Thank you, Mark. That is such an important element of this. It is the fact that investors in real estate discovered that even though getting a mortgage was a little tougher than getting a mortgage on their owner-occupied property, the rates were essentially the same.
Correct.
And it was doable. If you fit the picture of what the bank was looking for, it was pretty much a rubber stamp for you to get an 80% mortgage on a rental property.
As opposed to, by the way, and this is probably the fundamental problem with Canada, as opposed to if I turn to a bank and say, hey, I want to employ 80 Canadians and build a business, they'll just turn to me and they'll say, well, that's great. We all have dreams.
Yeah, well, I'll make it even a little more crude. The bank will say, yes, that's interesting. Get the fuck out and don't let the door hit your ass on the way out. Okay?
That's right.
That's where we're at. So that coalesced. So once again, we're back in 2011, 2012. This sort of interest in, and it started then. It was like all of a sudden there was something that never existed before.
Correct.
A investment coach. An investment coach appeared back in 2011, 2012. It's real estate agents who build themselves, and by the way, some of them were great, okay, but not the majority. Okay, so there was people who said, look, I'm going to show you an idea about how if you fit the picture the bank has, we can easily get you levered up 80-20, buy this property, and it will completely service the debt. You will have a pay down of your principal, and over the course of time, it will have a magnificent result for you and your family.
Yeah, well, I'm going to disagree, and you should never disagree with Ron Butler, I find, in this industry, but I'm going to choose to disagree with Ron Butler for 1 second. It's not that real estate coaches came about in 2011, it's that they started saying something that was very different. Because the real estate coaches that existed back before then basically said this is a long-term play.
Yes, true, correct.
But the real estate coaches that arose in 2011, 2012 said this is much more like a stock. This is a short-term play. And so what we had was a different breed of coach, indicating a different mentality to the investment opportunity that condos presented.
So Mark's not in trouble. Most people get in trouble and disagree with me, but Mark's not in trouble because he's correct. There's the evolution of the real estate coach who, and by the way, some of those guys stuck around. Some of those guys you can sort of find today who still believe that the only rational approach to this, investing in real estate, is as a long-term hold. But quite rightly, Mark is pointing out that certainly in the latter stages of 2012, 2013, the new coach, who we will call the flip coach.
That's right.
The flip coach appeared.
That's right.
And somebody who is promoting the idea of owning investment real estate as quick capital appreciation, that your real estate will rise rapidly in value and you can sell it and pocket a big profit.
And before we make those people out to be evil, they happen to have been right.
Yeah, they were right.
That's the critical component.
They were right, yeah.
These were not coaches that were acting without the client's best interests at heart. They were correct about what they were saying in 2011, 2012.
Now let's move forward to 2013, 2015, where something came into and let's talk about some of the other things that happened at that time. First of all, Airbnb started to gain a lot of traction starting 2015, 2016. Airbnb became a thing. It didn't even exist. Like, there was no such thing as an app that could turn your property into a hotel. That did not exist. Okay. So that got going, and that presented a huge revenue lift for somebody who owned a condo, because a condo could be turned into an illegal hotel.
Well, if we could just back up for 1 second, because I know you and I are actually very familiar with real estate and how it's valued. But just for those people who don't spend their time reading mathematical books about financial math, the idea of an income stream can be converted into a present day value. So what that means is the monthly amount that you net dictates what the price of an asset is.
Sure. And the return dictates how much the value of the asset is.
That's exactly correct. Yeah. And so when you bring about the fact that Airbnb came about, we are recalling that the entire strategy that started in 2011, well, 2000 before then, but 2011 really got going, was predicated upon an underlying rental base.
Yes.
And the amount of money that was coming in from that rent dictated how much someone could then afford on a monthly basis, because it was covering the costs.
Exactly.
Right? Now, when you bring up Airbnb, just for your listeners, what you're saying is, people were able to significantly raise the monthly nut such that the net that they were resulting from on a monthly basis was higher.
Which stimulates the value of the asset.
Exactly.
Yeah.
And as a result, because the only math Canadians care about is how much does this cost me per month versus how much do I take in. And no matter how much you want to scream yourself until you're blue in the face that perhaps taking on $6 million of debt is not a good idea, and someone will say to you, but it covers through rent. You know, that is not, it's an anathema to the Canadian thinking. The Canadian thinking is, what's my monthly nut and do I cover it? Plain and simple. Airbnb allowed for that number to grow significantly.
So this was the difference. Airbnb, you could say, was the difference between cocaine and crack.
Correct.
Okay.
Correct. But prior to Airbnb, after 2011, somewhere between 2011 and 2015, 2016, because we're talking historically, people also started to hear about another dynamic in the market, which was the exits. Because, of course, if the coaches in 2011 were starting to treat this as a stock, part of investing in the stock market is also when you exit.
So now we're going to go so those people in 2011, those sort of novices, were the weed smokers. And now we're going to talk about assignment, which took them up to cocaine.
That's correct.
Okay.
That's correct. So you had two factors that were making the condo market post-2011 ever more appealing. The first was the fact that rentals or rents and the ability to derive income from your asset continued to rise, and did so with significant aplomb, really, after Airbnb comes in. But the second was the exit opportunity, because people suddenly realized that this truly could be, not always, but could be a short-term play.
Right. So assignment, just to make sure all the listeners can follow along, the idea of assignment is when you buy a pre-construction condo, you go into a sales office and you pick your unit and you have a price. You have to come up with a 20%, 15 or 20% deposit on that unit. The unit is not expected to complete for between 5 and 6, and maybe if you're a very small building, it's 4.5 years.
Correct.
But there is a time lag. You're buying a futures option. So
Correct.
you're putting a deposit down, and you will only know the true notional value. You bought it for 400, and you're not sure what the notional value will be in the 5 years, but you're hoping for a appreciation during the course of the 5 years.
In two respects. It's a futures in two respects.
Yeah.
One is the absolute value of the product, which you can capitalize on at any time.
Mm-hmm.
And the second is in the rents, which are continuing to go up as well, meaning that at the end of the day, it will produce income for you at a higher rate than you had expected when you signed your initial contract.
And when we're talking about 2014 through 18, 19, we're talking about very significant appreciation of rent during that period.
Yes. Well, there were other factors that are probably a bit beyond the scope here, but we had massive foreign investment.
Which, yeah, so I've explained assignment. Assignment created an opportunity for people to make money without ever taking possession of the unit. Because assignment was, hey, I bought this unit in 2014 for $309. It's now, it's not finished yet, but it's 2017, let's say. It's 2017. And God damn it, the place is worth like $525. So that I think I'm going to let somebody buy it from me for $525 because that seems like a good idea based on Airbnb style rents. And lo and behold, when I advertise it in a way that's not on MLS, somebody shows up and writes me a check.
Yeah, and the real problem there when Uncle Bob went ahead and made $230,000 was not that Uncle Bob made $230,000. It's that Uncle Bob didn't shut up because Uncle Bob has never made $230,000 in his life.
On anything.
Right. And Uncle Bob, around that turkey dinner, would not shut up about his $230,000 and then double down. Because after all, Uncle Bob's a genius. He's made $230,000 for very little work.
And he told every single
person in the world had to hear about Uncle Bob's $230,000.
Correct.
And by the way, did Uncle Bob invest $230,000 well, taking that money? No, Uncle Bob bought a Lambo and then put down $50,000 more on a condo. But
on the next condo, yeah.
Uncle Bob was a product of his time more than he was a financial genius, but nonetheless, Uncle Bob wouldn't shut up about those investments. Meanwhile, nephew Jim, who makes $60,000 a year and hates his boss, has to listen to Uncle Bob talk about that endlessly.
Yeah. And we're now seeing the seeds, not the seeds anymore. We're now seeing the saplings of what we're going to come to in 2025. But here's one other area of Mark's deep expertise: foreign capital buying properties in Canada. You go right ahead, Mark. Tell us about it.
So, I mean, I guess I can speak about this because it's been over 10 years, but I was actually involved in bringing foreign capital into Canada.
From China.
From China and and from other jurisdictions as well, yes.
He was doing it legally, folks. There was nothing illegal about what he was doing.
It was totally legal. I mean, I can't speak to whether the Chinese people were acting legally. But
it might not be legal in China.
From a Canadian perspective,
yes.
Totally legal. Everything is done above board.
Yeah.
No issues.
Yeah.
By the way, there's never an issue in Canada because if it passes into the wire system in Canada, this is totally irrelevant, but once it gets into the wire system in Canada, so long as it hits the bank account, you can't, obviously there's FinTrack and all of the...
But what we're going to say is simply this: there's no capital controls on money coming in. Okay, that's how it works.
Right, exactly. That's pretty much what I'm getting at. Be all and end all. A whole lot of money started flowing in from certain jurisdictions, but particularly China. China actually, it's estimated, constituted approximately 7% of the investment monies or the investment condos that were being purchased by the time 2016 hits. By the way, you know why I say approximately? I say approximately because CMHC, which most of your listeners will know is the insurers behind mortgages, also has a research arm. And that research arm was totally functionally useless during the 2010s decades. I asked them many times for information as to what the capital flows that were coming into this country to buy real estate were, and their response was, this year we're concentrating, I'm not kidding about this year we're concentrating on the commercial market in Moncton.
That was their whole project.
That was their big project in 2016. At the time that 7% of all condos being purchased were it's estimated through Chinese capital. They were busy investigating the commercial market in Moncton. I mean, I wish people in government could be fired sometimes because they're honest to God. It's just, anyways. Putting that aside, 2016 was a sea change because that was the first time that Trump was. This is all not really relevant, but it's kind of interesting.
It's very interesting. It talks about the genesis of how this got out of control. 2016
was the first time that Trump was elected. Was that right?
Yeah, absolutely.
2016 was the first time Trump was elected. Mm-hmm. And there was, like today, a dispute that took place with China immediately. And one of the reactions that China had that not a lot of people realize is that they decided to diversify for the first time away from the North American currency basket. It was originally seen that North America was the only currency basket in which, after you make money, you try to flee China with that money. You put it into the North American currency basket. That's where the security is.
So just for the listeners, this is people in China who have made a ton of money in their own businesses because China created this weird world where they believed that entrepreneurs would be able to lift millions and millions and millions, hundreds of millions of people out of poverty. But they also intended always to run a totalitarian dictatorship where the government was in control of everything. But they realized they needed entrepreneurs to get things going. Now, eventually, entrepreneurs came to the conclusion that, you know what, I don't totally trust my government. So I'm going to try to move some money offshore so I have a safe place that it exists.
I love how you say it's entrepreneurs. Actually, a lot of government officials realize that there's a ton of money that tried to make its way offshore. And when it did, placing it in the North American currency basket was de rigueur until about 2016. When Trump started his first attacks on China, they decided to diversify. And what that meant, it's estimated, again, thank you CMHC for providing no help on these stats. It's estimated that the investments fell from about 7% to 3%. That's the common understanding. Again, I don't really know where the data is to support this. This is just what I've heard over the course of many, many years. So please understand, this is all anecdotal and really patched together. But it's estimated that it fell from about 7 to 3% or
but
so.
But you understood the intensity of it. Because, and let's face it, folks, when we say 7% of billions and billions and billions of dollars just going into deposits on real estate is a lot of real estate.
I went to the Shanghai Property Show in 2017, and I bore witness to developers here in Canada literally advertising as they do here, but going into closed rooms where they would sell whole floors of condos.
10, 12, 16 units.
Whole floors of condos. And they had a whole setup going on in Shanghai. And I'll never forget it in 2017 when I attended the Shanghai Property Show. I went to the entirety of the place. I would estimate, now we all understand we're 30 million people in an 8 billion person world, which a good portion is China and India. But still, I would say 20% to 30% of the people who were there were Canadians.
Canadian Chinese.
Canadians just advertising to Canadian Chinese.
Oh, so, okay. Canadian developers and real estate agents. Gotcha.
Everyone understood that that's where it was. And the thing about the Chinese investment and foreign investment generally that took place between 2013 and 2016, when it abruptly stopped from China,
drastically slowed.
Yeah. Is that it created, it incentivized and it ignited what Uncle Bob was saying. And it pushed it to a degree unheard of prior to that. So whereas Uncle Bob went ahead and made $150,000 or $230,000, suddenly you're starting to hear stories of people who made $300,000 or $400,000. And
selling condos by assignment.
Correct, selling condos by assignment, and that's because the demand outstripped the supply.
All right, so let's talk about let's summarize it. So we had an Airbnb boom that allowed for rents to look enormously better. We had overseas money pouring in so that units would get snapped up by a floor at a time, and that means you're encouraging the shit out of developers to build. I mean, that's reality.
But it takes a while for them to build.
And it takes a while for them to build, so they're taking deposits. And you also have a kind of brio, a bubbling enthusiasm to buy this stuff as a surefire investment. So everything comes together at once. And another really even potentially more awful phenomenon happened at the same time. Cities and municipalities became interested in charging more development fees. So I want you to talk about that for a minute, Mark.
I could talk about that for more than a minute, Ron. Perhaps it's almost even a bit too early to get to them, but I'm going to get to them here. So what happened was we started to see, when I said that it takes a while to build a condo, what I mean is it takes a while to plan a condo. And so
that could be 3 years before you start digging.
Correct. Yeah. And as a result, if the demand is insatiable, then, if the supply is limited.
Demand is insatiable.
And demand is insatiable, that's where the price starts going up fast.
Not on a natural basis.
On a natural basis, just simple supply demand.
Yeah.
That's where the assignment market suddenly looks like the greatest opportunity that this world has ever seen.
Mm-hmm.
That, before we get to the government, then ignites the bubble. And like all bubbles, like the tech bubble in 2000, and like bubbles that all of us have partaken in and seen, bubble investing is different than value-based investing, than cash flow investing. Cash is no longer king. Cash has no bearing on anything. Doesn't make a difference.
Just appreciation.
All that matters is appreciation. And now it's not Uncle Bob telling you about 230. It's Uncle Bob telling you about the fact that he doubled down and now he has 500. And now he has 2 Lambos because he never invested very well. Uncle Bob really needs to get...
He never puts the money into GICs.
Never.
Okay, yeah.
Never, ever, ever. And by the way, all the Lambos are leased because he can't afford the whole thing anyways.
There's that, yeah.
But anyways, let's keep going. So we have Uncle Bob who's bragging, but we also have other foreign investors who are looking at this and saying, these are pretty good returns.
Mm-hmm.
This is very interesting. Meanwhile, the Canadian economy is still not a great place to invest for business or anything else.
Yeah, that's never changed.
No, it hasn't changed throughout this entire story. In fact, it has changed, but for the worse.
Only worse.
Yeah, we'll talk about that because that's a fundamental criteria that takes place after 2016.
Mm-hmm.
And so where we are is we suddenly develop a story where there becomes insatiable demand on the basis of a bubble, which is different than insatiable demand on the basis of rising rents and with the cherry on top of capital appreciation.
Mm-hmm.
Now capital appreciation becomes the whole game. And even though in 2016 foreign investment may have flowed, it pushed up the actual values of the assets sufficiently that people entered bubble territory.
Because if somebody is buying a whole floor pre-construction, that place sells out instantly. So the developer can go on to thinking about the next one right away.
That's correct. And they can roll it over. And as a result, what we started to see was, as I said, bubble territory. Now, here's where the government got involved, because this is really the most nefarious part of the story, because we look to governments to have a sober second glance, to not be financially motivated on an individual basis to protect us.
Protect society, the good of the community.
That's what they're there for.
Yep.
But as we became heroin addicts, they became pushers. And that is the worst part of this. Because the governments, let's take the city of Toronto. The city of Toronto has a piss-poor revenue model. Part of that is constitutional, because fundamentally, when 1867 rolled around, there were exactly 2 entities that had control of taxation. One was the province, one was the federal government, and the municipality isn't even mentioned.
Mm.
And accordingly, they are not allowed to put in sales taxes or any other sort of taxes. What they're allowed to do, plain and simple, in 2016, is they're allowed to collect property taxes, and they're allowed to collect development charges from builders, which, again, because in 2006, as we started the story, it wasn't a very big thing in the first place.
Okay, and quick rollback to those 100 years since 1867, the builders were building low-rise homes. They're building single-family homes. So it's reasonable to say, hey, we need a road. We need a sewer. We got to put in a parquet. There's going to be a library required eventually.
Correct.
All the schools. Like at one point, all property tax was just a function of school boards taking a tax to build schools and keep schools built. So you could make an absolute case, rational case, that if you're building houses, whole subdivisions of low-rise houses, there must be development charges so that you can pay for the roads, pay for the sewer, pay for everything else. The interesting part about condos is the road was there. You're building at King and Yonge, okay? The library's there. The parquet's somewhere far away, but nobody's using it anyway. the sewers are there. You may need to expand capacity slightly, but everything was already there.
But your point is that they start taking in taxes greatly in excess of what is required for the actual physical structure.
Correct.
It becomes a base revenue line of the city,
Yep.
which doesn't have many base revenue lines.
Right.
And that is true, and that was true prior to about 2016, 2017 as well. But in 2016, 2017, prior to that, if they had raised rates, if they had raised development fees, and they did, they absolutely did.
Significantly.
But when they raised those rates, it directly affected demand for product. But after 2016,
in a bubble.
That's right. In a bubble, it didn't.
Yeah.
And that's where they are to blame, because then they saw their opportunity. They understood, the municipalities, Toronto in particular, understood that they could raise their development charges, their Section 37 levies, their park levies, all of these are significant, to any amount that they wanted. And people would continue to pay. Why? Because they weren't basing it on fundamentals. They were basing it on the fact that there'd be a sucker behind them that would pay them more than they paid.
The greater fool.
That's right.
Right.
And it's wrong to call it the greater fool, because if you can actually do this, you make a lot of money. Like, you're not a fool if you can get out before the bubble bursts.
But the guy who's left with holding the bag is the greater fool.
Is the fool 100%. And so many of them aren't doing that right now, and we're seeing that. But what happened?
So the interesting part about when you talk about the city of Toronto, when we talk about these condo development fees, they probably went up from the very, very nascent beginnings of 2010 or before that. They've probably gone up 1,000%.
They went up 1,000%. There was one famous episode where John Tory, in his final year before he decided to run off with whichever woman it is that he ran off with.
No, she ran away later, but go ahead.
He eventually ran out of breath, and she
left. Yeah, she left. Yeah, that's right.
In his most famous act, in my mind, he increased development fees 100%, which, just for context,
in one day.
In one day, which for context meant that on a 2-bedroom, it went up from $64,000 per unit per 2-bedroom to $128,000 per 2-bedroom.
You can't make this shit up, folks.
Didn't
you can't make it up.
affect demand an iota.
No,
not even a blink.
There's no check on demand when it's just a notion of future fortune. Okay.
Exactly, and as a result, the city of Toronto still has the lowest tax rate in like any jurisdiction. Period.
No, Vancouver's cheaper.
Is Vancouver cheaper?
Vancouver's cheaper,
okay. All right. Well,
it is a famous.
So this is the problem with doing a podcast with you. I usually can just spout these things and not be corrected.
Yeah,
but there you go. All right. So
now we're actually going to move into present day. So what was happening so just to really nail it down, what was happening by the time we got to 2019 and 2000 is that, and there was also one. You made a great point before we started the show. For decades, for the first couple of decades of condos, the beauty of them was that they were always significantly cheaper per square foot than building a house.
Correct.
Always significantly cheaper. What happened in 2019, 2020 is that completely departed. The idea was we were going to charge $1,400 a square foot, which was significantly more than anybody would ever charge to build a detached home. So, and by the way, enormously higher than what condos were selling for resale at the time.
That's right.
So
predicated upon the idea that in 5 years,
rents would catch up, rents would expand greatly. Some other miraculous occurrence would appear, because bottom line is, with Uncle Bob, you only make money on this thing. You never lose.
100%.
Okay.
But before we get to the present day, we have one other thing we need to mention, which is fundamental, which is that for the past 10 years, Canada's economy, though it appears on its surface to be functioning well and the bankruptcies are down and everything else, our productivity was in the toilet.
Oh, ridiculously bad.
Right. To a point where we have actually fallen to one of the lowest productivity rates in the OECD.
Alabama's more productive.
Right. It's than Ontario.
Yeah.
Than Ontario. Like, you want to compare Alabama to Saskatchewan?
If you want to compare Alabama to Newfoundland, you might be in trouble. Right. Yeah, real trouble.
Anyways, point is this. Productivity.
We love you, Newfoundlanders.
Yes, we do. Yes, we do. And by the way, Newfoundland is a place that everyone should go. It's awesome.
It's a great place.
All right. Yes, all right. Okay. Their check back cashed for you too, because the Newfoundland Tourist Board gives me a check every year.
I just want to avoid the screaming comments about how we're not being fair to Newfoundland.
Their beer is good. All right. So the be-all and end-all is, what does productivity have to do with the story? Well, productivity directly informs wages. And if wages have failed to keep up or exceed expectations, then the divorce that takes place between the rising real estate values is exacerbated by the underlying ability of Canadians to hold that asset.
Because a stagnant wage means you are limited in what you could afford as rent.
Correct.
You're just limited.
That's correct. That's exactly right. So now we can come to the present day. So now what we have is we have a bubble economy where the governments have been a pusher, where ultimately Uncle Bob has never lost money, where investment dollars have flowed in massively, where your per square foot fees are above, in some instances, single detached homes.
And virtually no one expects to need a mortgage because you're going to sell by assignment.
Correct. Actually, I can speak to that because I run a real estate practice that is only real estate. That's all I do. And the amount of people that I spoke to on new builds that swore up and down to me that they were not buying this on assignment was exceptional. I would have the same conversation over and over for 10 years. Please do not be purchasing this just to assign. I am not doing that. Those same people in droves are coming back to me saying I had no option but to assign. That was the strategy all along. It was a clear, obvious lie. And it's not to say that they were lying to me. They were lying to themselves.
Okay, so now we have reached present day. And what is happening in present day is that there is no more assignment market.
No.
It has disappeared. Airbnb has been crushed by government regulation. Foreign money is departed. Investors have finally come to the conclusion that if they can't assign something, they have to try to make this work on rents. Oh my God, it's impossible to make it work on rents.
That's right.
I'm going to lose massively on every condo that I've bought. Okay. And that's where we've reached it today. We've reached a point where people are confronted with, I have to keep it. I can't sell it by assignment. I'm going to have a hell of a time getting a mortgage. I never, ever expected to really own this thing. And what am I going to do now? Because it looks like the value's falling. If I don't have the right bank appraisal behind me, the appraisal, what's called a blanket appraisal, the appraisal is coming in far less. It's coming in $200,000 less or $300,000 less. I can't find that money to make up the difference. And if I close on an asset that's actually reduced in value from the day I bought it 5 years ago, it's down now. It's the opposite of up. It's down.
Correct.
And not only that, if I did find a way to close, I would have the honor of losing $1,200 a month based on rents today. And rents in a year are probably going to be less.
So the interesting factor, I'm going to back up 2 years before we get to the present day. 2 years ago, the assignment market went illiquid. You just didn't know it.
Because it's an unknown market.
No, that's not why.
Okay.
2 years ago, the assignment market went illiquid, but people already had a sunk cost in for 20% of their deposits.
Yeah, the deposits are in.
And as a result, they started losing money on assignments about 2 or 3 years ago.
So they were actually willing to lose money to get rid of that property.
Correct. But so long as the value of the properties was within a 20% band,
because that was
that's
the assignment.
That's the traditional deposits.
Yeah.
Then the assignment market stayed liquid insofar as it was functional. Because
liquid, but a loser.
That's right.
Okay.
But you could still get rid of the product.
Out of the contract.
Exactly.
Okay.
A year ago, that changed.
No longer could you do that.
Because the values of the product went down more than 20%.
You would have to pay the guy out of your checking account.
Correct.
Lose your whole deposit, pay out of your checking account in order to get rid of this contract.
So we closed that avenue.
Yeah.
What other avenues closed? Well, the government, in its perfect wisdom, right at the height of the bubble, put in place investment controls from foreign buyers.
Yeah, you couldn't. Foreign buyers can't buy anything.
Right. So you have the PPRP and the NRST, which stand for something. Who cares? Just basically, it's harder to bring investment money into Canada than it's ever been before. And investment dollars, by the way, are not something that you necessarily need to be scared of. Investors that own a product still want to derive rents and everything else from it. It's the vacant products that are a problem.
Okay, but now let's arrive at today.
Okay, yeah, sorry.
Let's arrive at today. You described something and have been describing it for the last year, is sort of the graph of fail to close. So somebody bought a property for $1,400 a square foot. Across the street is a similar building that's only 2 years older.
Right.
That's selling for $875 a square foot. So you are doomed.
This is the story.
Yeah.
If you guys are just looking for a place to kind of come in at this point, whatever the hour is on the YouTube thing, this is it right now. Because this is the story that is going to spread the contagious.
49.
Right, there you go. What we have here is the essence of the problem. In the same way that Uncle Bob talked a lot around his kitchen table about how much money he made, there is now I think we had talked about the knowledge that people used to have as cab drivers in England.
Yeah, in London, you had to study for years and write this elaborate test that you knew every single turn of the city, and it was referred to as the knowledge.
The knowledge. And the knowledge in Canadian real estate for many years was that you can make money on assignments. And the knowledge that is spreading now in Toronto,
because social media
is that actually you can walk away.
Okay, that you can just go to your developer, say, I'm not closing. You can keep my deposit, and I'm going to forget about you.
Correct. Now, there are repercussions to this. In fact, I did a whole video on the repercussions. It immediately made 1,200 hits in a single day or something, and I didn't even make it for public consumption. I made it for my own clients. But now other lawyers are using this simply to show people what the ramifications are. There are ramifications for walking away, but it's legal to breach a contract. And I'm going to start there.
You don't go to jail.
No. It's illegal to drive 101 kilometers down a highway. It's illegal to trespass on someone's property. It's not illegal to breach a contract.
That's a tort action.
That's correct. Or even or criminal action, perhaps in some instances with battery or anything else. But it's not illegal to breach a contract. There are consequences, to be sure. And the consequences are not just the release of the deposit. They can come after you for more.
So you lose your deposit for sure when you walk away.
Yeah.
That's gone.
Yeah.
But I guess what we're talking about here is the mitigation of damages.
Correct. And then the builder is allowed to pursue you for whatever their actual damages are, minus the deposit that they've already taken.
But they have to mitigate. They have to at least try to sell the unit. Is that rational?
Well, they have to mitigate. They don't. There's case law out there that says they don't. I don't want to be all lawyerly here, but there's case law that says it doesn't necessarily require you to sell. But yes, the idea is they have an obligation to mitigate in an expeditious way, and you can challenge them if they haven't done so. And in most instances, that means sell.
Right.
Yes, 100%.
So what we're faced with now is the knowledge through both front page of the Star and the Toronto Star and through social media groups that keep talking about this endlessly. The knowledge that, hey, I thought I was going to be in unmanageable trouble and forced into bankruptcy if I don't close on this condo.
Correct.
But it sounds like now all that happens is I lose my deposit, which is gone. It's been gone for 5 years. And I can sort of walk away from this thing. So I might as well. I'm just going to tell them I'm not closing.
Right.
And that's a hockey stick level increase in numbers.
So let me share with you some of these numbers, because I was just a couple of months ago saying that the numbers are at 25%. I firmly believe they're now above 30%. That is to say, of all new products that are ready for people to take them over.
New developments, yeah.
Correct. About 30% of people at least are walking away. And I'll tell you how I know these numbers, because there's no sources on this.
They keep it quiet.
The builders are keeping it quiet. But I have a pretty good source, which is shocking, but I do. I'm a lawyer. I do enjoy the sound of my voice, the melodious sound of my voice. I try to get on these podcasts and everything else. And as a result, people approach me when they have problems. And you know who's approaching me now? And I'm not talking about one group. I'm talking about multiple groups at this point. 4 or 5 groups at this point. They're the listing agents that acted for the builders.
Because they only get paid the bulk of their commission when the deal closes at the end.
And if they've been paid any commission, then the builder can claw back in the event that they don't close.
Oh, I forgot that part. The builder's coming after these people.
The clawback matters.
Yeah.
And here's the critical component. These listing agents sold every single unit in the building. Yeah. So if they're clawing back a percentage, it's an accurate tally of what the failure rate is on the building.
Very accurate.
Right. 25 to 30% is coming from these stats. And this is, again, not one group in particular.
So this is
multiple groups that have approached
we're moving past anecdotal. We're moving past anecdotal into a data source that's little understood, but is real.
Yes.
And this is telling you that we're getting up into the 30-35% range of people who are just saying to the builder, the builder's saying it's time to close.
25-30. That's where I'm ready to go.
But I think we're going to see that change radically in the next couple of months.
Yes.
we know through this method, and by the way, it's a brilliant method. We know that looks like 25, 30% of people who bought those pre-construction condos just saying, no, I'm not closing. I'm not closing at all.
And Ron, the interesting thing, and we've talked about this many times privately, the interesting thing is that 2027 is going to see product that is more expensive than today hitting the market.
Yeah, 1,400 goes to 1,700.
Right, exactly. Yeah. And so the hockey stick failure rate doesn't just come about because people are talking, but because the financial reality of the situation gets worse.
It's worse. So, and again, and by the way, folks, this is a key, really big, important key. Rents continue to drop for new rentals.
Well, okay? that is, if I had one thing I want people to take away from the show, it's that very point.
All right. So let's get into contagion.
Yes.
So we're going to guess that this hockey stick graph will continue upwards.
Correct.
And eventually we hit a number where 50%, and we might hit it this year, easily hit it this year, where 50% of the buyers say, I'm not going to close. At that point, you got a problem closing the condo corp, right?
Correct. Well, you need 50% of the units to transfer in order to have the condo corp's first meeting and everything else.
So what I'm talking about now, folks, is that the builder can't form the condo corp. And, it could get to 60s and 70s. We don't know. Percent of people who will say, I'm not going to close. The builder has a problem, not just with themselves having a problem, but with their bank covenants. They have a problem.
Well, bank covenants, for sure. But I've and again, forgive me, because again, you don't challenge Ron Butler, but still, I'm going to do it. I've never actually seen, I know I've heard you speak about that many times. I've never seen that as the fundamental problem, because if you go to 60%, I'm convinced that there'll be some investor out there, there'll be some bank, someone will own them, turn over the units, and then rent them out. But it's in the rent, it's the fact that these physical units exist in their incantation, and the only way that they revenue generate is through rents, that ultimately allows the contagion to spread. That's where I think the story is.
So the true contagion that we're discussing is, set aside what a bank is going to do if their covenants are broken. We'll just pass on that for today. But when these people who can't close, and I think this is a truism. Does anybody just own one pre-construction condo?
No.
Yeah.
People who are coming to my office are telling me stories of 4 or 5, and sometimes on incomes of $60,000 a year.
Sure. So what we got here is a true tulip bubble burst.
Correct.
It's like, hey, the only way we assign valuation is that somebody was willing to pay more.
That's right.
There's no underlying value. There's no mathematical sense to this, because there is no mathematical sense to this stuff. In any kind of a rental purchase, any kind of investment to be a landlord, all you think about is rents.
That's right.
Versus income versus outgo. That's all it's supposed to be. That disappeared in
Cash has not been king for 5 years.
2015, it disappeared. Okay, so where we reach right now is, where did they get the deposits? Where did the deposits come from for these people buying 2, 3, 4, 5 condos? You've got to put the deposit down. So it came from, in all likelihood, a HELOC on a house.
Correct.
That's where it came from.
Because Canadian productivity has been in the toilet. The only asset that they've been able to realize on has been their homes. And this is where the contagion is. Because whether or not a unit fails to turn over or not, it's hitting the market. And the only revenue generation material for that unit, as you call them, mostly dog crate condos, is rents. And as a result, even if the market is flooded, that unit is coming to the market for rent. And what we're going to have is a classic oversupply of product.
Right. And this is really important, because people keep challenging me on this. Ron, in a housing crisis, which we know exists, how can these condos have so little value, or why can't we rent them? Because, folks, rent is the outcome of these stagnant wages.
That's right.
So it doesn't matter. You can invent a story. And by the way, can we put a roommate in there? Hell no, it's 485 square feet. You might have to sleep standing up if you're a roommate. Okay?
Because we're reverting to the real. And if you're wondering, because people at home are probably wondering, well, how does that work? I mean, a physical body doesn't go away. Well, no, but a physical body will stay with mom until the age of 30 now, or 32.
Or somebody will couch
parents,
surf. Somebody who loses their job will couch surf.
Or parents will move in with kids.
All of that.
We are, this is how it happens. And the problem that we have now is whether it's dog crate condos or not, we have an abundance of them hitting the market, pushing down rents.
40,000 units
and
over 2 years.
And when you can push down rents, and even if they're all in one area of the market, it starts to affect the rents of all. Because
Exactly. This is really important that what Mark's brought up. That somebody who thought they were safe in their condo that they bought in 2012 that has got okay rents and you paid so little for it, the goddamn monthly maintenance fee keeps going up, the property tax goes up, and if rents are coming down because these massive number of dog crate condos are hitting the market that have to be rented because it's a receivership thing or it's somebody stepped in and bought the place for 50 cents on the dollar, whatever it was.
That's right.
That the only asset is to push out the rents. They have to come down. Right now, we got some people offering 3 months free rent on a 2-year lease. So it goes on and on.
Now, this is where the contagion is.
Right.
Because so many of us, even those people who didn't partake in the height of the bubble, are reliant on rents in order to fund investments. We have what is effectively becoming an illiquid resale market if you take a look at the MLS stats of the past couple of months, which, by the way, is not going to be getting any better thanks to Trump and his tariffs.
Mark, thank you for bringing up that point because this just proves a lot of that resale market where you see these listings surging in condos. Some of them are 2010 condos. Some of them are condos that people paid very little for.
Correct.
But they may have, comparatively little for. They paid $299, but they leveraged it up. Sometimes they took money out of the condo. They refinanced.
That's right.
And with these falling rents, they just say, I got to get out.
That's right, but they can't get out.
They can't get out.
And as a result, what we have is we have falling rents across the board, even if you don't have dog crate, because dog crate is the bottom of a market that is connected all the way up to expensive rents.
Yes.
And because people just keep moving down as they find cheaper and cheaper product. And as a result, it's not supporting Canadians who invested in real estate, even on a cash flow basis.
Even at good prices, conceivably.
Correct. And so what we're going to see is as more and more products hits, particularly as the 2027 pricing goes through.
And 2026 too, I think.
Yeah, 2026, 2027 pricing is probably going to be the top.
Yeah.
We are seeing the contagion spread to the broader market. That's what we're starting to see now. Whereas before, it was limited to condos. It was limited because we were in the assignment market, which remained liquid until the deposits came down. Then the assignment market went away, but people then did everything they could to do this, and then they sold, and a couple of people are now walking away. It's when these products are created, whether they walk away or not, and they start hitting the rents, and then the rents start then affecting all of us who have income properties and rely on that because our incomes suck in this country. That is when it spreads to everything.
So a pricing error, because that's all you can call it. When you were buying a pre-construction unit that was 25% more expensive than what was selling across the street from the sales center, like you were buying something that was radically too much money, that is now going to eventually, not for everyone, but for some, it's going to actually spread to people who bought a condo for $299.
100%.
Yeah.
Particularly because those people who bought a property for $299 have refinanced out the wazoo to afford other products, have refinanced in order to afford their life because their income hasn't been sufficient for a long time. And so the $299 product that they have is actually pretty equivalent to what a 2017 product is anyways, because they've refinanced up to that point.
So to sum up, because the podcast can't run for 2 hours, but it's been a great podcast. I knew this was going to be great, and it was great. So to sum up, this is a moment in time when we can believe a couple of things. Number one, there's not going to be a new condo project started in Southern Ontario for years and years.
Yep.
That's number one. Number two, everybody's going to sort of figure out that building a dog crate condo, 485 square feet, was a dumb fucking idea, and hopefully they stop doing it.
Yep.
Okay. But there's going to be a long time in between because we ain't going to build any condos for quite a while in Southern Ontario.
By the way, it's not that it was a dumb idea. It's just in aggregate. Like, I'm sure that there's room for a limited number of dog crate condos.
But not a building full of them.
Exactly.
Okay, all right. And there will be contagion. Contagion means that people who thought they were fine, they didn't buy a dog crate. They didn't buy any new condo. But suddenly they're finding the rents declining on the condo they refinanced because they did. And the property tax keeps going up and the rents keep going down. and the goddamn prices keep going down. Maybe I need to sell this for even cheaper than I thought I could sell it for.
And in an effort to be succinct and only make one last comment, can I just put a cherry on the top?
Sure.
Cherry on the top is what's happening presently politically down south. If you take a look at what has been targeted in this country, what has been targeted is steel and autos.
Mm-hmm.
And if we think about steel and autos, what does that affect? What's one city does that affect more than any other?
Hamilton is steel
Hamilton
town.
it is.
Steel
and which one went up faster than anywhere else in the entire country?
Oh, in 2021, what we refer to in our business as Mortgage Christmas, it was Hamilton.
It was Hamilton.
Had great growth.
The West End of Toronto is going to take it in the shins, and it is very clear that in addition to everything we've just discussed, we have the unhelpful actions of our politicians, not necessarily ours, but politicians that are directly targeting our weakest link. It's going to be an interesting ride.
So that is so absolutely true. Now, this was not a program about tariffs, but if we just pretend that the tariffs last for 9 months, who knows? But let's say 9 months, the material effect on the auto industry in Ontario is going to be quite real.
It's done.
Well, we don't know it's done, but it could be quite real. So what does that mean? That means that more unemployment, more people not being able to afford rent,
right?
More people, and by the way, it's not just automotive. If you harm automotive, bankers are going to let people go. There's less lending going on. We don't need as many folks. Okay, all kinds of people get let go. The stores let people go because people are buying less in the grocery store. It's that bad, like a bad recession, folks, which we've never seen since 1990. Don't count 2008. It was over in 14 months. We haven't seen it. We don't know what it's like. So this bubble in the condo market could easily spread, but it will definitely be exacerbated by unemployment. There's only really 3 things the chief risk officer in a bank worries about. I'll tell you what those 3 things are. They are unemployment, unemployment, and unemployment, because that's the key to unsavable debt losses. You have to write off capital, because if nobody can pay because they don't have a job, you're writing that off, baby. And if enough of them are unemployed at the same time, all asset values are falling. That's the way it works.
Rob, to quote Community, this is the worst timeline.
All right, listen, it's been a great show. And if people say, well, you guys are way too negative, you're way too down on this, a year from now, things could spring back to life. The only real response I can have to that is, fuck no. That's not rational, okay? We got $1,400 a foot condos that are selling across the street for $850. $850 can go to $750. The next year, 2026, the $1,400 condos are $1,550. Okay, like this is a rolling disaster that's not fixable under any means that we understand now. It's not to say government won't step in. Government does crazy things. Not to say that there isn't some kind of miraculous change. All of a sudden, Trump decides in fucking Labor Day that it's time to take the tariffs off. I don't know. Nobody knows. But right now, any rational person believes this is going to be really, really bad.
I agree.
And if you want to call that negative, you can. But the truth is, and by the way, some people don't have to worry. If you're a couple of school teachers who never bought any condos, you're fine. If you're a cop, if you're a fire person, I guess we got to use the word now. I'm still stuck on fireman because I'm old. And if you're people with a safe government job and you have no other investments in real estate besides your home, I guess you're good. But there's a shit ton of people who are not those people. And that's not going to be fun.
Ron, as a final word, I'll tell you this. I deal with a lot of people who are in problems. And I, over the course of my career, have learned the expression, the truth will set you free, to be actually something that is fundamental to how you get out of messes. The fact that we are identifying problems and calling these things out for what they are and not properly identifying the contagion is frankly the only way out of this mess, because the bubble was irrational exuberance. And rationality is desperately needed, and a proper assessment to cash flow investing needs to be the thing that will drive our performance going forward. It's going to involve a lot of pain.
And the final word is letting people know that walking away might be a more successful alternative to trying to find a way to close on that condo. Making this known, and some people say, well, Ron, you're advising people to do things that could put them into litigation, and that isn't good. You shouldn't do that. Well, I'm just here to say it might be better than losing money for the next 6 years on rents.
Yeah, and to be very clear, it's not Ron Butler getting them in shit. They were in shit the moment that they put their signature on paper and crystallized a promise to pay an amount that the market no longer supports. It's a question of how you get out of it. And litigation is a strategy, as is closing, and you have to weigh both.
Mark, thank you. This has been the ultimate Condo Crash segment in our podcast series, and I think it was fantastic. Thank you, Mark.
I appreciate it, Ron. I'm very grateful to be in the chair.
Thank you.
If you like the pod, well, don't just sit there. Go to YouTube, Apple, Spotify, and all the other ones and like the pod. And don't forget to subscribe so we can keep being angry at mortgages and swearing about mortgages. Angry Mortgage could use your support.